As of 10:41 a.m. Eastern Time, Monday, November 3rd, 2025, Sound Hound Ai, ticker SOUND, is trading at $17.77, up about 0.85% on the session. Now, the expectation for a stock like this, one that is at the very center of the AI voice recognition space, is that it's on a one-way trip to the moon. Investors look at the partnerships with automakers and restaurants and see the next NVIDIA. But the immediate reality is something far more complex and, frankly, far more dangerous. This isn't just a simple growth story. It's a high-stakes battleground. And what most of the public narrative is missing is that while retail investors are piling in, a staggering amount of sophisticated capital is piling up on the other side, betting heavily that this stock is going to fall. The data on this is undeniable, and it paints a picture of a company at a critical crossroads just days before its next major test. The common belief is straightforward. SoundHound is the independent solution for voice AI. In a world wary of handing even more power to Google, Amazon, or Apple, SoundHound offers a customizable, powerful alternative. You're seeing its technology in Stellantis brands like Alfa Romeo and Hyundai vehicles, and you're starting to see it in drive-thrus. The company is projecting explosive revenue growth for 2025, somewhere in the range of 97% to 100% year over year, targeting 157 to 177 million. The last time it reported earnings for Q2, it absolutely crushed expectations. Revenue more than tripled, the stock leaped 26% the next day, and ran up 54% in a single week. This is the narrative. This is the expectation. But here is the challenge, the reality check. If the story is so perfect, why is the company's cash burn accelerating? Why are top-level insiders, the CEO, the CFO, and the TTO, all selling millions of dollars worth of their own shares, as they did just last month in October? And most importantly, why is nearly a third of the company's tradable stock currently sold short? The reality is that SoundHound's path to actual sustainable profit is far less certain than the stock's hype would have you believe. Let's look at the recent trading. The stock has been incredibly volatile, carving out a 52-week range between $4.97 and nearly $25. Right now, it's in a state of technical indecision. The Relative Strength Index, or RSI, is sitting right in the middle at 50, showing no clear momentum. Yet other indicators, like the stochastic RSI, are in overbought territory, suggesting this recent pop might be running out of steam. The moving averages are completely split, with as many buy signals as sell signals. This is the technical signature of a stock that is coiling, building up energy for a massive move. The question is, in which direction? The volume has been average, but the entire market is holding its breath for one single event, the company's Q3 earnings report, which is scheduled for this Thursday, November 6th. This report will be the catalyst that resolves the tension. It will either validate the bull's explosive growth narrative or confirm the bear's fears about cash burn, and the resulting move could be violent. Before we get to the short selling data, let's briefly cover what the company actually does because it's important. SoundHound has two main platforms. Houndify is its suite of tools that lets businesses, think car companies like Stellantis, or electronics makers, build their own branded voice assistants. This is their key value proposition: independence from big tech. Their other big push is the Amelia platform, an enterprise-grade AI agent for customer service, and their AI solutions for restaurants, which aim to automate the ordering process. They just signed a new partnership with Telarus in October to push these enterprise solutions even further. On paper, the business model is strong. They have a massive backlog of contracts, and the growth is real. The Q2 report proved they can deliver shocking top-line growth. But growth at what cost? That Q2 report, the one everyone celebrated, also showed the company burned through $24.7 million in cash. That's more than the $18.7 million it burned in the same quarter the prior year. And to fund this, the company has been selling new shares. The total number of shares outstanding has more than doubled in just 3 years. This is shareholder dilution, plain and simple, and it's a core part of the bear thesis. Now let's talk about the element that is defining this stock, the short interest. As of the most recent data, a staggering 102.8 million shares of SoundHound are sold short. That accounts for 28.07% of the entire public float. To be crystal clear, this means that for every 10 shares available to trade, nearly 3 are bets that the price will go down. This is an exceptionally high number and makes SOUN one of the most heavily shorted stocks on the entire market. The days to cover, which measures how long it would take all shorts to buy back their shares, is 3.8. That's a significant number, implying it would take almost a full week of average trading volume for shorts to get out. On platforms like Reddit and X, this 28% short interest is seen as pure rocket fuel for a massive short squeeze, and it's a primary reason many retail investors are buying the stock. They are betting on a repeat of the Q2 earnings pop, which would force this massive short position to buy back their shares at any price, sending the stock flying. But this is where we have to dig into the reality of the data. While the short interest is high, the cost to borrow those shares is currently very, very low at around 0.55%. This is a crucial contrarian detail. When a stock is hard to borrow, this fee spikes, making it expensive for shorts to maintain their positions. A low borrow fee, despite high short interest, suggests that shares are still easy to find. This makes a spontaneous squeeze less likely. The shorts are not in pain. They are sitting comfortably, waiting. What they are waiting for is that earnings report on Thursday. Their bet is that the company will reveal a continued, perhaps worsening cash burn or guide lower for the future, which would validate their thesis and send the stock tumbling. And they are also betting that the intense competition from Google and Amazon will eventually cap SoundHound's growth. What's your take on that 28% short interest? Is this smart money seeing the cash burn, or is it just fuel for a massive squeeze? For anyone invested in this or thinking about it, you need to know how to track this yourself. You can find short interest data on platforms like Fintel or Ortex, or often in your own broker's advanced tools. It's typically updated twice a month. But you must also watch the borrow cost rate and the fails to deliver data. Fails to deliver, or FTDs, are instances where a share doesn't deliver to its buyer on the settlement date. While there are many mundane reasons for this, a large, persistent spike in FTDs can sometimes suggest naked short selling or settlement failures. SoundHound saw a massive spike in FTDs in late September, with 1.65 million shares failing to deliver on September 24th alone. This is another piece of data that gets the short squeeze crowd very excited. You should also watch the options chain. A huge volume of call options expiring in the money can create a gamma squeeze, where market makers are forced to buy the underlying stock to hedge their positions, adding fuel to a rally. But be warned, chasing a squeeze is one of the riskiest plays in the market. A high short interest is not a guarantee. You need a powerful, positive catalyst to ignite it. So who's on what side? We've already established that retail sentiment is overwhelmingly bullish, focused on the technology and the squeeze potential. On the institutional side, the smart money is completely divided. F12 filings from mid-year show that Vanguard and BlackRock are the top institutional holders, which is typical for index funds. But the real story is in the active managers. Bank of America, for example, massively increased its position, buying over 15 million shares, a 196% jump. At the same time, Morgan Stanley and UBS ran for the exits. Morgan Stanley dumped 5.8 million shares, cutting its position by 59%, and UBS sold off 33% of its stake. This is not a consensus. This is a clear disagreement among the largest financial institutions in the world. And as this battle rages, company insiders, the people who know the business better than anyone else, have been selling. This brings us to the future outlook, which hinges entirely on this Thursday's earnings call. There are two very clear paths. The bull case is that SoundHound once again delivers a massive revenue beat, shows that its automotive and restaurant backlogs are growing even faster, and, most importantly, provides a clear and believable timeline for reining in cash burn and achieving profitability. If they do that, the 28% short interest will be trapped, and we could see a squeeze of epic proportions that sends the stock flying past its $25 high. The bear case is that the revenue growth, while still present, begins to slow. Or, more likely, they beat on revenue, but the cash burn is even worse than last quarter. If the market senses that the company is on a treadmill of endless dilution just to fund its growth, the shorts will be proven right, the stock will break technical support, and the insiders who sold will look like geniuses. Comment below with your prediction for the earnings report this Thursday. Will SOUN beat expectations again, or will the cash burn finally spook the market? Ultimately, the story of Sound Hound AI is the perfect embodiment of the modern market's tension. The expectation is a disruptive AI pioneer on the verge of dominating a multi-billion-dollar industry. The reality is a deeply unprofitable, cash-burning company that is diluting its shareholders to survive, all while being targeted by a massive, entrenched short position. The technology is impressive, but the financial realities are severe. This is not a buy and forget stock. It is a high-stakes bet on whether the company's growth can outrun its expenses before the market or its own checkbook runs out of patience. The battle lines are drawn, and this week, we're likely to find out who was right.